Hi everyone, welcome to the masterclass on valuations today. We are going to go deep into the valuations. How do we do valuations? Um what are the pros and cons of different valuation techniques? So we'll be talking a lot about valuation from equity perspective. Uh, let's start with it. What is valuation? Valuation is the process of finding out the worth or value of an asset in today's terms. For example, um, when we go and purchase any asset or any share in the stock market, what we can see is the price at which, let's say, the stock is trading. But is that price undervalued or overvalued in the market? That depends upon what is the value, what is the worth we see in it. Based on that, we can estimate whether it is, according to us, it is overvalued or undervalued. So how do we do valuation of that? That is what we are going to focus on today. Valuation is the process of determining the estimated or intrinsic worth of an uh, or value of an asset, investment, company, or financial instrument. It involves assessing the economic value of the subject based on various factors, data, and methodologies. Valuation is a critical aspect of finance and investment decision making, as it helps individuals, businesses, and investors understand the potential value and risk associated with their assets or investments. So, what we are trying to say here is that valuation is the process of valuing an asset, investment, company, or financial instrument. So, valuation is relevant whether we are trying to buy a property, a piece of land, or we are trying to buy, let's say, an iPhone, or we are trying to buy any stock. So, in different scenarios, we do valuation. For example, let's say there is a new iPhone launched at price of 1 lakh. Now, one person can say that this is uh, worth in terms of the benefits it is providing to the person, and that person would feel that it's a good deal, and that person may buy the iPhone. Whereas the other person, for that same iPhone, can say um, it's not worth that much according to me, and that person may not buy the iPhone because that person feels that it is overvalued, overpriced. So uh, that simple way of estimation we do, right? For example, let's say we want to buy a 2 BHK house. Then in that case, we can look at various aspects to do our valuation according to us, what should be the worth of this, and then we compare it with the price. And if we feel that price is justified according to the benefits it is providing us, then we go ahead and purchase the asset. Otherwise, we do not, right? So at various steps in our day-to-day life, and in terms of various financial decision making, like analyst wants to give a recommendation for a particular stock. So the analyst will do the valuation of that stock and then figure out what recommendation should be given: buy, sell, or hold, based on comparison of the intrinsic value that analyst comes out with versus the current market price of that stock. So that's why we say it helps a lot in decision making, especially investment decision making, as it helps in understanding the potential value and risk associated with assets or investments. Let's understand it through an example. From the equity perspective, National Stock Exchange provides us a platform, a website where we can check the current trading prices of any stock. So let's say we are looking at Asian Paints. And it is currently trading at 2236.10. So what we see here on the website of exchange is the uh, last traded price. So last trade happened at this price. That means there are buyers and sellers, as we can see from the order book, and based on the quantity in the order book, based on the price in the order book, the trades get matched, and then the trade happens, and this is the last traded price. So now let's say there is a potential investor who is planning to analyze Asian Paints. So before before we do any investment decision making related to Asian Paints, what we need to do is we need to do valuation of the company. So only then we will be able to decide according to us, is this worth the price or not. So that means we will do our own valuation. There could be different valuation techniques which will apply, and then we will come out with a particular value. If that value comes out to be higher than the current market price, we will say, according to us, it is undervalued in the market, and we can buy and gain from the potential expected increase in price of the share. Whereas if we do the valuation and the value, intrinsic value we find comes out to be lower than the current market price, then we will say that it is currently overpriced in the market and we should not buy it, or if we have it, we might sell it because it is currently overvalued in the market and we expect the price to come down later. And that's the basis of equity valuation. That's like the summary of what we do in equity valuation to give any recommendation. How the trades happen in market. Market is a collection of different participants having different views. So at the same price of 2236.10, there would be participants in the market who feel it is undervalued and they would like to buy the stock at this price. And at the same time, there would be a set of people who would feel this is overvalued and they would like to sell this stock at this price. So that is how trade happens. When the matching of order, buy and sell orders is done, that is how trade happens. So for the market to work, for the trades to happen, we need people with different views. People who feel currently it is overvalued and people who feel currently it is undervalued. Then only the trade can happen. All right. So let's move on to some myths related to valuation. First myth is it is an objective search for true value, which is not the case. All valuations are biased. The only questions are how much and in which direction. The direction and magnitude of the bias in your valuation is directly proportional to who pays you and how much you are paid. So what we are trying to say here is that that all valuations are biased, depends on who is getting the valuation done, and accordingly there could be some biases, some conflict of interest. For example, let's say CNBC TV 18 is owned by Reliance. So it might happen that you will very hardly see sell recommendation on Reliance on CNBC TV 18. At max, you may hear about buy recommendation or a hold recommendation, but most probably not the sell recommendation. Similarly, let's say a company is getting acquired, um, company is open to acquisition, uh, they themselves want to get acquired. So in that case, if they want to find the value, the correct value at which they should be receiving in the market, so if they hire an investment bank to do the valuation for them, then that IB um, may come out with a value which is slightly higher than the realistic value in the market. So um, it depends upon uh, who is doing the valuation for whom, and I mean, who is paying whom and how much is being paid. So due to that, there can be biases. For example, a company planning to go for IPO and they hire an investment bank. So IB is getting paid by that private company. So there are high chances that they would definitely not undervalue the company. They would overvalue the company. Then maybe what it is worth, they will try to value it higher than that in the market because they are getting paid by that company. So there are chances of such biases coming in. Second myth is that a good valuation provides a precise estimate of value. No, there are no precise valuations. The payoff to valuation is greatest when the valuation is least precise. So again, can anybody exactly find out the precise value of any company? Not possible, because uh, there are always estimates involved, there are always assumptions involved, and humans doing the valuation, there are chances of biases getting involved. So nobody can say that this should be the value of uh, this is the correct value. They can say that according to me, this should be the value. So there is no precise estimate as such for value. As we discussed, for the same asset, somebody can feel that it is overvalued and somebody would feel that it is undervalued. Uh, that is how they will place their buy or sell orders, and that is how trade happens. So in fact, we want people who have different views on valuation. Uh, if everybody feels this is the precise value for a particular asset, then trades may not happen, right? That asset will be priced at that, and there may not any trade happen. Then somebody should feel it is undervalued, somebody should feel it is overvalued. Only then the trades can happen in the market. So uh, that's why we cannot really say that there are valuation is a precise estimate of value. Whichever method we look at, be it absolute valuation, be it relative valuation, there are pros and cons of all techniques, and accordingly they can impact the eventual valuation we come out with. Myth number three, the more quantitative a model, the better the valuation. No, again, sometimes we feel that more complex the model looks, uh, more variables it has, uh, more the number of sheets it has, uh, the better estimate it will be able to provide. That may not be the case, because more complexity means lot of input variables, lot of estimates, lot of assumptions being made, and with every such estimate or assumption, there are chances of too optimistic assumption, too conservative assumption, or uh, um, biases getting involved into making such complex models. So the more logical, the more common sense the model has, it might give a better estimate of value than maybe a much more complex model. Next, where do we use these valuation techniques, right? So when do we do valuation, or which are the use cases for valuation techniques? First is merger and acquisition. So here we do valuation of target company for the purpose of merger or acquisition. So that is one case where we do the valuation. For example, Tesla wants to acquire an automobile company in India. So what they will do is they will hire an investment bank who will help them in finding the potential targets in India, and that investment bank would also do the valuation of target companies. So that is how they will be able to advise on what is the value that should be paid for a particular stake in the organization. For example, recently, for example, Ultratech Cement acquired a 33% stake in India Cements recently. Walmart acquired stake in Flipkart. So when they are acquiring stake, what is the price they should pay for particular stake? Let's say 20% stake or 30% stake. So for that much stake, how much should be the price? What is the estimate of price that should be paid for that acquisition? Now, it can depend on a lot of factors, and that is where assumption or estimates come in. A lot of qualitative factors also. Maybe the buyer is desperate to enter into that market, or is it a very niche business in which the valuation is more from the specific services the company is providing, which nobody else is providing. So a lot of different factors can come into play when coming out with a eventual value we pay for merger or acquisition. Similarly, in cases of IPO, valuation is done. Whenever a private company wants to go for IPO, become a public company, they would hire an investment bank, and they would get their valuation done. So at what price they should list their shares. For example, LIC came out with a 21,000 crore IPO in 2022, and recently we saw Hyundai India came out with a 28,000 crore IPO in 2024. So again, how do we decide how much stake we should sell in the IPO, and what should be the value we should get for per share? So in that case also the valuation is done, and then that price is determined. Next, we have business restructuring. Valuation to understand how much value we can unlock for the company by restructuring its business activities, say spin-off of non-performing segment of the business. So if you see some big companies like ITC has recently decided to spin off its hotels business, right? So ITC Hotels will be listed as a separate entity now. So that means they would have felt that as a conglomerate we are not getting enough value, or if we spin off our ITC hotels business and get it listed as a separate company, the value would be more than what we are getting as a combined entity. So that is where also valuation comes into play, that how can we increase the overall value of the firm, and that might include doing business restructuring also. So in such cases also valuation techniques are employed, and we do valuation of such cases. Lastly, private equity investment. PE firms, they invest in small companies or startup growth stage companies. So they are also doing the valuation. Now the perspective can be a little bit different, that we are investing in this company now, we will want to have an exit 5 years later, this is the growth we are expecting, and this is the multiple at which we plan to exit the company. So in such cases also they will do valuation. And what we see in, for example, Shark Tank, right? There are investors, potential investors, and there are startups which go and pitch their ideas, and those potential investors look at various aspects of the business, its future growth potential, and then they decide whether to purchase any stake in it or not. And if yes, if they want to purchase, then at what price they want to do the purchase, for 5% equity, 10% equity. So again, the valuation comes into the picture in such use cases as well. Let's look at different approaches to corporate valuation, or different techniques. Broadly, we have income or earnings approach, economic profit, and other approaches. In income or earnings approach, what we do is we use the future expected earnings to measure the free cash flow of the company to measure value. Value can be estimated either using firm cash flow or equity cash flow and discounting it appropriately. This method is known as DCF method. So this is one of the most popular, most widely used techniques, DCF approach, in which DCF stands for discounted cash flows, in which we estimate the future cash flows, and then we find the present value of those expected future cash flows to get an estimate of the value for the firm. Now, those future cash flows should be free cash flows. So that means those cash flows which are available for distribution, those can be considered as returns for our capital providers. So capital providers include debt and equity. So free cash flows to firm belongs to both debt and equity, and free cash flows to firm can be distributed to debt and equity providers. So we consider those as relevant cash flows while doing the discounting. So those are considered, and if we are considering free cash flows to the firm, we will use the discount rate as WACC, and if we are using free cash flows to equity, we will use the discount rate as cost of equity, and then we will discount those cash flows to get the present value. That present value is an estimate of our enterprise value or equity value. We'll discuss this in more detail later. Secondly, earnings capitalization method. This is relatively straightforward and simpler as compared to DCF. In this, we basically see what is the earnings potential of any asset For example, if it is a rented property, we may see what is the historical rent we have received from this property, and we can assume a reasonable growth rate to estimate the future earnings potential of this property, what is the future expected rent from this rented property, and then discount it back. So that is earnings capitalization. Similarly, for a dividend paying company, the dividends we are going to receive, that is our earnings from that stock. So again, what is the expected growth in dividends, and accordingly we can discount back those dividends to get a present value of future earnings. That is our earnings capitalization method. Next we have economic profit measures. Under this approach, value is defined as the sum of the present capital employed and the sum of the present value of projected economic profit. So what we do here is, there is a certain return we need to generate on our capital. So capital can be debt and equity. That is what we call as WACC, weighted average cost of capital. This is the minimum return we should generate on our capital which has been provided by capital providers. What are we doing over and above that, right? So what is our ROIC, return on invested capital? So ROIC, return on invested capital, how much better it is from WACC? It should be greater than WACC. So what are the returns we are generating over and above the expected rate of return or the WACC? So those returns which we are generating over and above WACC are known as economic profit. So we can calculate the economic profits which are expected in future, calculate the present value of those economic profits, and add to it the current capital employed, current debt and equity. That will give us a estimate of the valuation of the company. So that is economic profit approach. This is not used too frequently, but yes, in some cases this might be relevant. And other approaches include relative valuation, asset-based valuation, contingent claim valuation. So in relative valuation, this is one of the most popular techniques. This is the most widely techniques where we do the valuation. This is quick, easy as well. So in the industry, this is most widely used relative valuation technique. Here what do we do is we look at other similar companies. For example, let's say I'm planning to value Asian Paints. So we'll look at Berger Paints, Kansai Nerolac, ExxonMobil, Birla Opus. So we'll value these companies at what price they are trading at, what is the valuation given by the market to these companies, and what is the average valuation or what is the median valuation multiples. If our target company gets those multiples, then what should be the value of our company? So that is relative valuation. For example, let's say we are looking at TCS. So these are the peer companies for TCS. So we'll see what is the P ratio, what is the EV to EBITDA ratio, what is the EV to EBIT ratio these companies are trading at, and accordingly, if our company also gets that multiple, then what should be the value for our company. So this is how we do trading comparables valuation. And next is transaction comparables, transaction multiples, in which we look at recent transactions. The problem with trading multiples can be that it could be biased because of it could be influenced by sentiment in the market. So sometimes the market are in a very bullish mode, and the stocks or assets are trading at a much higher valuation, whereas in a very bearish phase of market, everything could be trading at a much lower multiples. So the multiples could be influenced by the sentiment in the market, which may not be realistic in terms of the fundamentals of the company. So that is the challenge with trading comparables valuation. Transaction multiples are used in those cases where we have the actual transaction data available. For example, let's say we want to buy a particular flat in a society. So what we do is we look at what price other similar flats were sold in the market, and then we do some adjustments related to what is the, specific location of this flat versus other flats, parking facility, etc., etc. So we can do certain adjustments related to the prices of last transactions, and then we can get an estimate of the value we should get, and this is based on transaction multiples. Next is asset-based valuation. This uses existing assets as a base for valuation, not considered by many as an independent method. Okay, so here what we do is that whatever assets are there the company has, we will find out their value, right? So this is more from book value perspective. What we see in the balance sheet, that what is the value of assets after paying off the liabilities. So that is asset-based valuation. What we see as, what we can call as book value or net worth. Here the problem is that we are only valuing the current assets, all the assets, the current value of those assets, but we are not considering the potential growth assets. So that means if we consider company as a going concern, then a company would keep on reinvesting in new assets also. But this valuation approach ignores that. It is only valuing the existing assets. We are not considering that after 1 year they will set up a factory or something, they will invest more in other assets and keep on growing further. That we are not assuming. We are finding out more of the cost, more of the replacement cost for the current assets, the existing assets we have, and based on that we are finding an estimate of the value. So that is asset-based valuation. This would most probably come out to be lower than the valuation we will come out with DCF approach or relative valuation approach. Last is contingent claim valuation. This is used more in option pricing models. So this is used when there is a contingency. That means there is the value depends on certain conditions, certain things to happen, then the value would be, for example, in a call option, the money is made when, if we buy the call option, when the price goes above the strike price, that's when the gains start to increase. So it is dependent upon something to happen. So that's why we call it contingent claim valuation, which is mostly used in case of option pricing. At what price should the call option trade, or at what price should the put option trade? Look at assessment of alternative approaches to value measurement. That means let's look at pros and cons of different techniques. Though several approaches to valuation are available. The ones that are mainly used are the earnings based on DCF analysis, relative valuation based on earnings multiple. Each of these approaches has its own characteristics which need to be well understood since they determine the appropriateness of a particular method in a given case. The income or earnings based approach often scores over the other methods such as asset based pricing methods and relative valuation based on market multiples. This is because the cost approach does not consider some critical drivers of value as the income approach. So now if we look at different techniques, there are pros and cons. There is no one watertight technique which is giving us the correct value or precise estimate of value. No, every approach has its pros and cons. Among the different approaches, the most commonly used approaches are DCF approach and relative valuation using trading comparables. These approaches also have their pros and cons, but these are considered to be better than other approaches. For example, let's say a asset based or a cost approach. The problem with that approach is that it does not consider growth assets while doing the valuation. That means those assets which the company will invest in future and earn returns, profits based on those growth assets. It is only valuing the existing assets. So that is missing one of the critical aspects of value generated in the firm. Secondly, the income approach has several judgmental factors and assumptions to be made which make it quite subjective. The use of relative valuation is tricky since it requires comparing an apple to an apple. So if we look at the incomes approach or the discounted cash flow approach, the problem with that is that there is a lot of subjectivity, lot of estimates, lot of assumptions made at every step of the process of doing DCF. So that makes it extremely sensitive to the estimates we are using. There could be a huge change in the valuation we come out with if some of the estimates are changed. That is like the limitation of DCF approach. That is the problem with the DCF approach, that it is highly dependent upon the estimates or assumptions we have made, and they may turn out to be true, they may not turn out to be true. For example, imagine the DCF valuation models built by analysts in January 2020. They would have estimated a growth in all the companies based on how they have performed in the past and how the future is looking like. But suddenly in Feb and March of 2020, COVID breakout. So all those assumptions went for a toss. All those DCF valuation models turned out to be wrong. So this is the problem, and there is always that uncertainty involved. So making assumptions, making estimates about the future is a very subjective and debatable always. So that's the limitation of DCF approach. With respect to trading multiples, relative valuation, here we need apple to apple comparison, right? So when I'm saying that I need to compare TCS with HCL Technology, Wipro, Infosys, so we need to find very similar companies. Now that may not be possible always. Some companies are unique in their business model and it is very hard to find similar companies, and looking at what those similar companies are trading at, we may not be able to find the companies which are very, very similar and which can be used as peer set. So if that is not possible, if we are not able to do apple to apple comparison, then the relative valuation, trading comparables valuation, may not be the best approach to go with. So when the business models are unique or comparable data is not available, the relative valuation approach would not be appropriate. So as we discussed, there are different techniques and they look at different views, and that is why the value coming out from different techniques would always be different. For example, if we look at comparable trading analysis, it looks at the valuation for similar peer companies that are publicly trading. It is looking at market view. Market participants move the stock prices for peer companies, so this technique shows their view. So in trading analysis, we are looking at the peer sets and how are they trading in the market, at what valuation multiples they are trading in the market. So this technique is showing their view, their perspective, those market participants, how they are valuing the other companies, and that is captured in the comparable trading analysis. So this is very much a market view. In precedent transaction analysis, looks at the acquisition prices for similar peer companies in recent transaction. So here we are focusing on the buyer's view. At what prices the buying or selling happened, at what prices who paid for which asset. So what was the buyer's view? We look at those transactions to find out the value of our target company. So here we are not focusing on market trading view, but here we are focusing more on buyer's view, at which the actual transactions happened in the past. And if we are doing DCF analysis, we are very much focusing on our view. That means, what is the analyst thinking about the company? What are the estimates, assumptions the analyst is making? So the DCF approach captures a lot of that analyst's view. There we are not looking at buyer's view or market view. So that means different approaches, different techniques are focusing on different things, different views, different perspectives to find out the value of an asset or a stock. And that is why the value that comes out through different approaches could be very different because of that.